One top strategist is drawing a parallel to another euphoric time on Wall Street, 2000. Julian Emanuel is BTIG's chief equity and derivatives strategist. Julian, great to have you with us. You heard all the traders making the same sort of parallels, but you say this time is different. Really?
Yeah, what I want to do is give you my word of the year, and it's a summary of all of theirs, and I would say it's retail. Okay, there's no question about the fact that the retail investor has had a better year by and large than most every professional. And part of that is being able to stick with the trend and stick with the momentum. And actually, when the momentum changed in September, retail changed and went towards the more cyclical place. All that having been said, there's no question about the fact that there are some parallels with 2000. The level of bullishness right now is very, very extreme. The call option volume is very, very extreme. The valuations are as high as they were in 2000. And so, Guy talked about valuations mattering earlier. They do. What we need to see is earnings support these valuations. I would suggest that's where the danger in the pullback lies. But what's really different about now versus 2000 is yields are much lower. There's a lot more cash on the sidelines. And actually, instead of the rally narrowing as it did towards the top in 2000, it spent the last several months broadening.
I wanted to ask you about that cash on the sidelines. So this is a stat that we got from the CNBC stock survey. 44% of those surveyed said that the amount of cash in their portfolio is about the same. 41% said lower than usual. 15% said higher than usual. I'm wondering, in terms of that cash, where is that cash? How do we know? I mean, is it being held by asset managers right now in cash? In other words, they're being paid to be in cash?
Well, it's difficult to differentiate, Melissa, because sometimes if you look at how cash was at the last major bottom in 2009, those levels were very high, but it took a number of months for that cash to actually start to find its way into equities because, frankly, that cash was a cushion against the recession. And that's where we still are. So while that cash, we do expect it to end up finding its way into the equity market, and it certainly did in November and early December, it's not going to be a straight line higher. And I would suggest that, again, when you're thinking about the professional money managers, yes, the cash levels are lower than normal, simply because, A, you're coming to the end of a very positive year. And frankly, if you've looked underinvested, you're likely to suffer for it.
Hey, Julian, it's BK. So I'm curious, if your word of the year is retail, what stops the retail investor? When do they stop investing? Is it because a recession comes and they need the money? And is there anybody for them to hand the baton off to?
Where it goes from here is much more difficult to say, BK. As we've seen, when the retail investor really does become the marginal price setter, as they have been for the last 6 months, you tend not to hand it off to anyone. But what we would suggest is if you look at the parallel to 2000, the retail investor was the marginal price setter, the bullish element for a full 18 months. So this can go on further. The issue is that where valuations are now and where sentiment is now, there are a number of things that could upset the market in the near term, and we wouldn't be surprised to see a pullback on the order of 10 to 15% over the next several months based on the virus accelerating, issues with the vaccine, or for some other reason that might upset the earnings apple cart. So, the market has definitely come a long way. It's not to say that, we don't think it can't go further. We think 4,000 at year-end 2021 is very reasonable, but near term is looking quite full.
What are the odds that BTIG puts on Georgia flipping the Senate? I feel like the markets are comfortable with the Senate remaining in Republican hands, but here we are talking about President Trump finally signing a stimulus package, and the markets had priced that was going to happen a while ago.
Yeah, and that's certainly, I think the market's reaction today is telling you that either way, however the Georgia Senate race sorts itself out, because the balance of power is going to be so fine, and the economy is still not really, on its full footing and probably won't be until the second half of next year, that the odds for further stimulus remain quite elevated. The one thing we would say is that there's this tendency to believe that the market could sell off if the Democrats take both of those seats in Georgia. We would say actually the long-run market history is contrary to that. In fact, unified government tends to outperform divided by government on the order of 300 basis points per annum over the course of 90 years. So we may be fearing that, but that could be sort of the trigger for that correction that we think might happen naturally, which would be a buying opportunity.
Julian, great to speak with you. Happy New Year.
Thanks. Happy New Year to everyone.
Julian Emanuel of BTIG.
Shepard Smith here. Thanks for watching CNBC on YouTube.